So, through surveying thousands of seven-figure business owners in Australia, there was a scary statistic that 77% of them felt like they were overpaying on tax. This is a pretty scary thought that the vast majority of businesses are overpaying tax. And from most of the business owners that I've spoken to, most of you don't like paying tax in the first place. So, we especially don't want to be paying any bonuses to the ATO. Now, we've analysed the results from our financial performance scorecard, and we've done some case studies to dive into why this is an issue and hopefully give you some valuable insights around what you can do about it if you also feel like you're overpaying in tax. So let's get stuck into it and work out how this happens and how we can get on the home stretch. So if you're not familiar with our financial performance scorecard, we've developed a framework based on working with thousands of clients and having them build over $3 billion in combined wealth of the top 30 things that get in the way of them creating financial freedom. If you haven't done it yet, click the link below, complete the financial performance scorecard, and you'll get a customized report that will show you exactly where you need to focus your attention. But the interesting stat was 77% of these businesses operate in trusts and companies, but they actually haven't optimized them in the last 12 months. They're paying corporate tax rates or potentially personal tax rates above and beyond what they should be paying because they don't have an optimal strategy around tax optimization. So, through working with these clients, we've been able to work out the reasons why this is the case and also what you can do about it. And there's basically 4 pillars of this structure optimization. So pillar 1 is the entity architecture assessment. We need to look at the current state. So we want to look at the entity types and we want to understand the tax implications. So for example, individual name, you've got a progressive tax system from 0 tax up to 47% tax, okay? Pretty straightforward. There's also other benefits, like you get the capital gains tax discount, and it's also very simple. But if you own assets in your own name, you have no choice but to pay personal income tax rates. Trusts give us flexibility around distribution, also has the capital gains tax discount. But a trust must distribute all of its profits every single year, otherwise it ends up paying the top rate of tax anyway. So the challenge is we need to make sure that we do have an optimal strategy around allocating. A trust is also not very good to run a business because of that forced tax outcome. And then a company, if it's a trading company, it pays 25% tax. If it's an investment company, it pays 30% tax. And it has the ability to hold profits within the entity without having to be forced to distribute. The other added benefit is that a company gets what's called franking credits. So when it pays tax, it doesn't forget that tax. It actually accumulates that tax, which can be used to offset future tax in the future. So we need to understand all of those various structures, and there are others that we can consider. Superannuation, there's unit trust, there's hybrid trusts, there's lots of other structures that we can consider. We want to look at your current structures, we want to look at the implications, and we want to compare it against the other alternatives. Next, we want to understand your income flow and your distributions. Like, what is the income that's coming through, both currently, what do we expect that to be in the future? How have you been handling that? We want to look at asset ownership and protection levels. So we want to see, well, what are the things that you're concerned about? What does asset protection mean to you? And how do you currently own your investments? And we want to look at compliance costs and the administrative burden, because there is no point adding extra complexity if it's not going to add value above and beyond the costs to maintain it. So the optimization opportunities that we consider is like income splitting through family trust, corporate tax rates used to allow us to accumulate retained earnings at 25 or 30%. Capital gains tax discounts for assets that you're looking to dispose of, right? Negative gearing potential if you've got high income and you want to be able to offset some of that. There's lots of things for us to consider. Now, pillar number 2 is the income distribution strategy. So, for example, a family trust provides a significant advantage, right? From surveying these clients, only 21% of the people that we survey doing over 7 figures use trusts for income distributions for lower tax rate individuals in their family or corporate beneficiaries, which we'll talk about separately. That's potentially $30,000 to $80,000 in annual tax savings that are lost. So we can't distribute to anyone, and there are rules that are in place, but there's a distribution framework that we follow. So we understand the family members and we understand their tax rates and thresholds. We work out how do we optimally split that income to minimize the total family tax. We get clear on the timing of those distributions to maximize the benefit. And we look at also integrating that with superannuation contribution. And the other factor is that you may not even have other family members to distribute to, but we can also distribute to a bucket company, which is a corporate beneficiary of the family trust. If you're paying 46% tax, it's better putting it somewhere that can pay 30% tax, right? So we had a client, James. 400 grand in business profit. His personal tax rate was 47%. We reviewed this structure optimization and we distributed 200 grand through a family trust to his spouse at a 19% rate, saved $56,000 in tax. But that's not chump change, guys. It's pretty valuable saving. Now, pillar number 3, asset protection. We implement structures for either tax flexibility and optimization or for asset protection. And asset protection is becoming increasingly important. So firstly is business asset protection. How do we separate business operations from personal investments? Because your business is probably the most risky venture that you're ever going to be involved in. And obviously, depending on the business, some are more risky. We want to make sure that we're not having any personal investments. It's also why I absolutely hate a business having a property inside their trading business. I recently saw this video by this very senior accountant that's on social media, been an accountant for like 35 years, and he was advocating for his clients to buy property inside the trading business. And he did not address that the business has the highest likelihood of litigation of any other asset structure. And we could have achieved the exact same outcome by setting up a separate company, buying that investment, that property through that separate company, and then creating a lease arrangement between the business and that separate company and completely isolating risk and achieving basically the exactly same tax outcome. Fundamentally flawed logic. Next, personal asset protection from business liabilities. So once again, we want to isolate that risk, making sure that you don't put any of your personal stuff on the line. Professional indemnity, right? Like the ways that we can insure and transfer risk so you don't even have to worry about the structures. It's far easier to have an insurance policy that will just pay out the claim than to try and hide your assets and wait for it to be tested. And then, of course, estate planning. Because we've got to realize that at some point in time, your business is going to be wound up. You're either going to sell it or you're going to die, okay? So it's important that you're going to have to plan for those contingencies. I know you think you're 10 foot tall and bulletproof, but you need to get your estate planning sorted. Investment asset protection. So property ownership through protective structure, like companies and trusts. Share investments. Similarly, we want to make sure that we're diversifying to maximize the asset protection. Superannuation is a phenomenal structure. People throw shade at it because they don't understand it. It is very complicated, but it is the most tax-effective way for you to fund your retirement, and it's also quite safe if you invest it appropriately. And then we want to have international diversification, right? We want to ensure that we're not just investing in our own backyard. If you've grown up in a suburb, don't just buy properties in that suburb. There's a whole country that we've got available. And we're in Australia, we don't have to just buy Australian shares. We are 2% of the global stock market. There's tremendous opportunities externally. And then pillar 4 is succession planning, right? Like succession planning is either going to be a family wealth transition. So at some point, we're going to transfer your wealth to your children, to other family members, to charity and other causes that you care about, or your business. Your business is going to have a succession plan. You're going to sell it. Maybe you hand it over to the family or potentially hand it over to your employees to run on your behalf. So you really need to consider, what does intergenerational wealth look like for you? What does wealth transfer look like for you? Is it something that you want to have done after you're no longer of this world? Or are you one of those types of people that wants to see the benefit of transferring the wealth while you're still alive so you can see the impact that that wealth has? These are really important conversations because it allows us to create what we call governance. And governance has nothing to do with the government. In fact, I think the government does a terrible job at governance. The idea here is governance is about creating rules and structure. How do we have conversations around how we want things dealt with? And how do we create frameworks that support those decisions being made so we get the outcome that we want? Really, really important. So I urge you guys that if haven't optimized your tax structures in the last 12 months, if you haven't sought advice around whether you've got the optimal structures, you're leaving opportunities on the table. So complete the financial performance scorecard. It'll take you 5 minutes. It's going to evaluate your profit strategy, your tax strategy, and your wealth strategy. And it's going to give you a customized report that will show you exactly where you need to focus your attention. So then you can start working on the things that really matter, whether it be a tax structure or whether it be something. So click the link below, complete the financial performance scorecard, and let's start optimizing that money that you work so hard to build.